Thank you for joining me this Friday morning. I'm happy to be here. I'm happy that you are here so we can talk about analysis of financial statements, financial reports. So let's get started. Today, the agenda for today is gonna be 3 points. We're gonna talk about the reports, its uses, its limitations, how to combine information from different reports, and we're gonna talk about decision-making and action planning. So how are you gonna change your habits? Are you gonna take all this knowledge into action? First, let's begin with some business resources around town here, actually around the whole state. We have the Department of Business and Industry Ecosystem and Roadmap. These resources are free, are totally accessible from their website, business.nb.gov. You should download this PDF file. It is a map that is going to take you through different stops, business subjects, and you can browse and you can learn more about resources within our state, and they are mostly free. But let's take the first point, analysis of financial reports. What are the 3 basic reports, its uses, and its limitations? So the 3 basic reports. We understand the small businesses wanna do their business. You know, they want to execute their ideas, they want to take care of their product, their service. It is not fun to create financial statements, but you are here to change that perspective, okay? We're going to tell you about why you should be doing this and how you can do this. You know, we have the 3 basic ones: balance sheet, cash flow, and then the profit and loss. Those are the basic 3 reports that we're going to cover today. There are probably more. There are combinations, always improving the financial reporting, but we're going to concentrate on those 3 today. But are the financial reports created? Everybody wants to have information so they can take decisions, but it is very important to take a step, back. Before creating any financial reports, you need to organize all the information that you have. The financial reports are the final product of a process that happened before, that you had to have established before. So the accounting process, the bookkeeping, getting organized, putting things on paper, however you want to call or describe the process. But you have to bring organized records, from the picture, so you can provide financial reporting in an adequate manner, okay? So every transaction has to be allocated to a particular category. Categories are, wages, rent, loans, interest, gas, sales tax, income taxes, revenue. There are many categories. Then the categories are assigned to accounts, and there are only 5 types of accounts. So all the money that comes in and out of the business, whatever it is, it has its own place. It has its own reason and purpose within the business. All those transactions are categorized, are assigned to a type of account, and then we can create the financial reports. It is very important to do this because we cannot start from the financial reports. We have to start from the organization process. How are things organized, detail, however you want to call it, put some order to it. So from these accounts, we have transactions, we have movement of money in all these type of accounts. But we want to allocate it in a more adequate format to analyze the information. And that's what it is. Profit and loss statements, balance sheet, financial reports, they are templates that help you organize and analyze the information. So in the profit and loss statement, we're going to bring all the income and expenses. On the balance sheet, we're going to bring the accounts that are assets, liabilities, and equity. On the cash flow, that's a very robust report because it will bring many of those informations. It will, the big difference on the cash flow, the balance sheet, and the profit and loss is that the cash flow brings transactions and not balances. For example, in the balance sheet, it's going to tell you how much you have in your checking account, a balance in the checking account. It's going to tell you how much you have in accounts receivable, what is your balance. In the cash flow statement, it will get recorded the transactions. You know, when do they happen? How many payments you have received in the last 3 months, but it's not going to tell you the balance, outstanding balance. Okay, so it tells you more about the what happened and not the where are you, what's the balance, what's your position on that particular point. Okay, so just keep that in mind, and we're going to go through the type of accounts first. So assets, you know, business assets are any cash or valuable goods, products that belong to the company. Assets will change based on revenue performance, acquisitions, investments, equipment, things like that. For example, if you made money 1 year, yes, your assets are going to change. Your bank account will probably go up. If you buy a company, if you buy equipment, your equipment value probably go up, and then your assets, like your checking account, will go down. Okay, so assets are anything of value and will change, will fluctuate based on the performance of the company. Liabilities, same thing. The liability is debt or obligations that a company owes to another party, such as investors, owners, bank, customers, everybody else, third parties. So these obligations will include, for example, IRS taxes, sales taxes, line of credits, anything that you have an obligation to a third party. And we have the equity. It is also called capital or net worth. It is money that would be left over if the company is sold. If you liquidate all the assets and the liabilities, you're gonna have left over your equity. You know what the shareholders or the company owners are gonna be left over with. Okay. Also, very important, the equity includes profits from previous years. So if, for example, Noel is going to ask you for your balance sheet that will show your equity, it's going to see, okay, this company has accumulated profits from previous years, and I can find it in here. We have the one that we all like, income. Income is the money or equivalent value that a business receives in exchange for providing goods and services. It's an exchange. You provide a product, a service, you get something of value in exchange, hopefully money, and not too many accounts receivable. That's an asset. And we have expenses, right? Expenses, money spent or cost incurred by the business in their effort to generate revenue. Expenses are basically anything that is normal and necessary to perform your business operations. Talk about the balance sheet first, okay? The balance sheet, like I mentioned before, it includes the assets, liabilities, and owner's equity. But the balance sheet is like the big report that keeps everything in order, right? Because your profit and loss will show you, for example, your income and expenses and your net profit. Okay, those are data information that you recorded and you come up with the net result. I made this much money. But the balance sheet is a little bit trickier because it has to keep the balance of all the assets that you have from your company is equal to your liabilities plus your owner's equity. So if you have something of value on your company, probably you incurred debt or the money was contributed by the owners, okay? So on the asset side, we have the checking accounts, the inventory, machinery, accounts receivable, deposits, all that. But how did we come up with a $10,000 checking account balance? Oh, maybe we took some loans, or maybe it was from the capital contributions from owners, or maybe from earnings or profits from previous years. Okay, so how come my assets went down? Did I maybe pay down my accounts payable? I owe money to my suppliers, so I paid it down. Or did the owner took money out of the company? Okay, so the balance sheet, the difference between the balance sheet and the other reports, it's that there's a formula that must be always balanced. The balance sheet is something that reminds us that the money doesn't disappear. It shouldn't disappear. It just transforms. The money can come up as an owner's investment, then becomes a product, and then becomes a profit or becomes a loan, but it will always keep the balance, and it will make you realize if there's a problem, because money shouldn't be disappearing at all. The balance sheet. This is kind of the basic format. The balance sheet starts listing your assets, business account, equipment, inventory. We have a total of 62,600. Then you start listing your liabilities, your loans, your inventory, your credits that you have outstanding, that you have to pay down, line of credits, for example. And then your owner's equity, includes owner's investments, income that you kept from previous years, money that you got from selling stocks and things like that. So always your assets are always equal to your liabilities plus your owner's equity. Okay, 12 plus 5,600, 62,600. That's liabilities plus owner's equity. I'll talk about things that the balance sheet can help you with and its limitations. The balance sheet, it can help you with, the net value of the business. How many assets are in the business. Tracking current and long-term debt. you can differentiate between outstanding loans that are payable in 1 year or more year, or you have more time. Overall creditors, owners, and liquidity. You know how much is your balances on your checking account. You know how much you owed to the bank and how much money was contributed from the owners. So if you analyze that, it's like, okay, this business is being just funded by the owners, or it has more loans outstanding from other banks, and that plays an important role if you're asking for additional funding. It can help you compare periods, analyze changes in assets, liabilities, and equity. You know, for example, your tax person is going to ask you, okay, give me a balance sheet of the 1st of January, and then give me a balance sheet of December 31st. With that information, you can compare what was the change in assets, in liabilities, and owner's equity. Did the owner have to put more money? Do you have more loans outstanding than the beginning of the year, and things like that? But it has its limitations. For example, income or expenses are not shown in the balance sheet. You know, yes, you can maybe find previous net profits from previous years, but you're not going to find a disclosure of expenses and income on take a period of time. Remember, the balance sheet, it takes a snapshot. Boom. This particular date at this particular time, this is the situation. On the income statement, it can take more of a range, okay? Range that can be analyzed, categorized, and you can play with it. Assets, also assets which cannot be expressed in monetary terms, such as skills, vendor, relationship, and customers list, are not reflected on the balance sheet. For example, you know that you have 100 loyal customers that will never ever leave your business. They will always buy from you. That cannot be factored in on the balance sheet. But yes, there's some value into that. And also the true value of assets. For example, if you buy a building, the building will have the original cost. If it goes up in value, market value, it will not be reflected on the balance sheet, okay? Let's talk about the profit and loss. You know, income statements or profit and loss are basically a summary. Sales, expenses, and what was the performance over that particular period. You can do weekly, monthly, yearly, every quarter, whatever you need. And you can make it as extensive or specific as you want. So you want to use it to find out about sales trends, category, expenses, how much is left over, am I making money or not? The basic format is this. You start with your sales or revenue, then you take down your cost of goods sold, basically the expenses that are related to the products directly. What you have left over is the gross profits. So then you take out your indirect expenses, your overhead, things that you will have to pay no matter what. If you sell one piece of equipment, 1 hour of service, you have to pay the entire rent. Okay, this is overhead. And then at the end, you have your net profit. So you can do it as extensive or detailed as you need to, okay? And it is not as detailed as you want, okay? Because probably what you want is a very brief profit and loss, but you have to think about what you need, okay? What do you need to keep track of? This one is very simple. We got some sales types. We got cost of goods sold and basic expenses. Then we have something more complex, more detailed. I don't want to call it complex. I want to call it that provides you with more information. Okay, it's more complete. You got payroll taxes, salaries and wages, commissions. You got revenue from other sources. You know, for example, if you are renting some of that space, if you are receiving interest or you are paying interest. So make it fit your expectations. Income statements, you know, they can help you track sales. Are you going up or down? How much money is left on the business operations after deducting your direct costs? You know, whatever the company generated cash or not. Are you able to pay loans or invest or pay out the owners if with the money that you produce? Definitely, if you are the owner, you want to keep track of what money, how much money is producing, your business is producing. The income statement has some limitations as well. The value of the business. The value of the business, you can definitely tell somebody, okay, I make this much money in the business. But the value of the business is going to be reflected on the balance sheet, okay? Because this is how much money you made. Great, good for you. But how much money do you owe to other people? Do you have a big outstanding loan that's going to come due next month? Okay. Money that is tied up in accounts receivable. Maybe you're making money, but clients are not paying you. You know, you're selling some stuff, but they are not paying you what about the products. Past performance of the business profits. So the profit and loss is going to tell you mostly on the, I mean, you can run historic profit and loss, but the balance sheet is going to tell you more about previous year's earnings and things like that. Also, the income statement is going to include only expenses. Sometimes it's the business and it is not an expense, okay? Personal expenses, things that are not deductible at all. So that is not reflected on the income statement, but that you can find it in the cash flow statement, because the cash flow, it will track everything that comes into the business and goes out of the business. How much money you have left to operate, how much money you have for emergency funds, for pandemic funds. So it measures, we have 3 parts of the cash, of the cash flow statement. You got the operating activities. It will measure the cash that it goes up, goes in, and goes out, that is related to the main purpose of the business. If you are providing a service as dentist, okay, those are operating activities. How much money is in personal equipment, dentistry supplies, and things like that. Lab expenses, anesthesia, all those things. You got the investing activities. That shows the purchase of a sale of long-term investments. Did you buy the building? You have to buy a new chair for the dentistry. You have to buy new X-ray machines to find all the problems. Those are investing activities. Financing activities. It measures the activities that fund the company and repayment of loans and owners. So this is how the business gets funded. This is where the money comes in from other sources because they believe in your business. And this is where the money goes out to repay, and the owners can take the return on their money. So those three areas are all part of the cash flow. Why do we have three areas? Because the money comes in and out for different purposes. And you want to know the purpose and how much is coming in and out. After that, we come up with a total net change. Plus minuses from all three categories are add up. And we know if we got a positive cash balance or change in cash. And this money is totally different from your income statement. Because in the income statement, you're not going to see the money that comes from the loan sources, right? If the bank gives you money, that's not going to be included in your income statement because that is not income. It's a loan. Income, you pay taxes. Loan, you don't pay taxes. But you're going to find it in your cash flow. Cash flow. It can definitely help you to visualize liquidity. Everybody must know how much money you have left over and also plan ahead. You know, avoid fees, avoid tax penalties, avoid being a bad boss and not paying your customer, your employees on time. It can help you analyze your cash cycle conversion. What is that? Is how much time it takes you to so you sold something, but how much money, how fast can you bring that money back into the business? The cash flow, definitely, it cannot help you on things like depreciation and amortization because those are accounting rules. You cannot see how much money the clients owe you or how much money do you have to pay out. You know, it doesn't keep track the amounts payable and receivable. Your net income also, because it doesn't keep track of the accounting rules and tax rules. It's just flow of money. So those three financial reports are very important, but we should use them together because together they are more useful. What's the most important? No, there's one report cannot provide the full story about your business and your financial situation. Definitely. You have to combine them in order to make proper decisions. You know, bank and investors and your tax preparer, they want to probably ask for all three, you know. So you need to make sure that the reports tell the correct story about your business. Otherwise, your business will contradict the owner. And it happens. The business financials will contradict the owner. And that is not a good situation to be on. You know, it shouldn't happen. Let's see about this. First, we have a cash flow statement right here and a profit and loss from a business, okay? So if we look at the cash flow, we began with $40 that the owner put in. We bought some product, then we sold some product, and then we had some expenses, rent, office supplies, and the owner took some money out. At the end of the month, we have $5 left over. That's very simple, cash flow. Now, the profit and loss. On the profit and loss, we're going to record how much money we sold and our expenses from buying the product and operating expenses. At the end, we had a loss of 25. So same numbers, same business, different views because they are different reports. Right here, we saw that the business lost 25. And over here, there's a balance of 5. You think, are you doing good or not good? Not good. I mean, the profit and loss will measure the profits. The cash flow measures your liquidity. That's it. Okay. So definitely different story for that. Let's look at another example right here. Cash flow, 20 at the beginning. We bought some product. We sold some product. We pay up rent, supplies. But the money, you know what? We sold $80. So the owner decided, I'm going to take 30 out. We make a good profit. We're taking money out. So on the P&L, it shows 80 sales, product, cost, rent, and office supplies. We made a profit of 15. Yes, because we sold 80 and our expenses were not that much. We made a profit of 15. But those 15 have to pay taxes, okay? And you better keep enough money in the bank account to pay those taxes, because making money is great, but you have to budget for growth, for employees, for everything else. So watch out for your liquidity from the cash flow statement and the profit and loss. Okay. Noel, are you here?
Yes, Juan, I'm here.
Oh,
Can you hear me? Can you see me?
Yes, I can definitely hear you, but not see you. But you know, you see small businesses all the time, every day. Do you think that the financial statements sometimes tell a different story than what the owners are saying?
First of all, Juan, thank you for having me, and thank you our attendees for coming to this class. And yes, to answer your question, so let me tell you this. This is what we have noticed in the practice. For good or for bad reasons, very few small business owners have an adequate accounting system or bookkeeping system, right? So sometimes we have clients, people coming for a loan, and we ask, so how your business is doing? Oh, my business is doing great. Okay, how did you know? Can you please show us your balance sheet, your profit and loss statement or income statement, and your cash flow statement? And they sometimes, yeah, they are like, well, I don't have it with me, but let me talk to my bookkeeper. I have the ones from the last year. Well, yes, but we are on August, and the ones from the last year are going to tell us the story from last year. So the idea is that sometimes the small business owners believe the financial statements are for bankers, loan officers, tax preps, but the situation is no. The main use of financial statements should be for the business owner. And the situation is that so many times the business owners, they think their business is good, and then when we start going into the numbers and actually building these financial statements, they realize that probably they are not making as much money as they believe, or maybe the cash flow is not as good as they think, or maybe the business is not worth as much as they believe is worth. So to answer your question, basically, there is a discrepancy of the beliefs versus what the financial statements actually reveal. Sometimes the story on the or on the perception of the client or business owner is different than the story the financial statements are giving us.
Yes. So right here, I'm showing you, your bank statement, your profit and loss, and your taxes. Please make sure that one doesn't contradict the other, right? Otherwise, it's gonna be very difficult to tell your story.
Actually, let me mention something real quick right there. If the statements, and I'm bringing this because what you mentioned, we have seen situations on which, for some reason, whomever prepared the statements, the statements are not telling the same story, each other. So when someone is asking for a loan, we do what we call cross-examination. And basically, the cash flow statement, the profit and loss statement, and the balance sheet should tell us the same story. Then, as probably you are going to mention when we explain this slide in a little bit more detail, we also go for other documents from banks, from tax filings, and from other sources like invoices or reports from the POS, the point of sale system on certain businesses. And all those documents should give us the same story. They should be consistent in order for a loan officer, and that's with any bank, okay? That I think that applies to the industry in general. All the documents should somehow tell us the same story, because if one is telling us a different story, that means something is not coming right with those numbers, and there is an area of opportunity that the business owner needs to address.
Definitely. Thank you. Thank you. And just because of we are having a great conversation, but it's Friday, we wanna keep you too much over here. And cash flow, there were some questions about how to create a cash flow. And if you want, we can send you the link of the class that is about cash flow. But, the cash flow planning, and definitely Noel wants to use the cash flow in order to see, how are things flowing inside your business. If you're looking for the startup money, make sure you're not asking for too little, or you have enough money to keep the doors open. Pay yourself. Cash flow will help you plan for this. The owners need to get paid as well. If you switch from a salary position to self-employment, definitely calculate your payment. Cash flow will also help you see if your pricing is not adequate. It's not adequate to fulfill all your compliance requirements, taxes, paying yourself and things like that, and also the overall operations. Cash flow will help you put aside payroll taxes, income taxes, emergency funds and things like that for future expenses that are coming your way. It's a matter of just when. Overestimate your revenue. Be realistic about it. Everybody loves its company, its business. But when you are asking for money, asking for loans, you have to have a plan A, plan B, the best scenario, the second best scenario. Decision making using financial reports, it's very, very personal to the business, because you have to know what do you need, how do you need, when do you need that information to make some decisions. Many businesses, they don't understand their financial statements. They relied on third parties, but those third parties are not running your business. Those third parties are not paying your rent, your personal expenses, the school for your children. So you have to understand and make sure you're taking care of the business. we have valuable input from professionals, accountants, taxes, marketers, but you need to understand your financial position. One thing that we can use are called ratios. You know, ratios are basically formulas, numbers that can help you compare your business with industry standards and within yourself. We have some asset management ratios. For example, the accounts receivable turnover. This formula is going to help you see how many days it takes you, you know, from selling a business to actually, from selling a service or a product to actually getting the money. Inventory turnover. This formula shows how many days it takes you to turn over and sell your inventory. So now we are taking particular accounts from the balance sheet and the income statement, creating a formula and coming with new information, new ways to measure our performance. You know, the inventory might come from the balance sheet, but your cost of goods sold will come from the income statement. So now we are combining information to make new information. We have liquidity ratios, working capital, you know, how much money you are from assets compared to current liabilities. Again, you have to know how much assets you have compared to your liabilities. That's going to help you see your long-term liquidity. You got profit margins. The profit margin is basically your net profit divided by your net sales. So this factor is going to tell you about your productivity, how much money, how are you converting the dollars, okay? How much you are getting on return. And these ratios are used by some of the lenders. I mean, what are the most usual ratios that you use, Noel? We keep going. So you have to change your perception. You know, financial statements are organized information presented in a meaningful way. But why you want to do this? Why are you going to go through all that trouble? Because it will help you diagnose your financial strengths and your weaknesses. You can visualize your behaviors and the overall performance of the business. The numbers will tell you the behaviors and things that are going good and they are doing bad. It helps to tell you the story to whatever reader you are presenting the information. Bankers, possible investors, yourself, your spouse, your partners, your family, you know. Sometimes, hey, they might think you're crazy, but hey, my financial statement's still a different story. So I'm not that crazy. I'm making money. My inventory turnover is low. My performance ratios are above average in my industry. So everything is going well. So we want to help you change your perception with the information. And hopefully this class was helpful to adapt or bring new behavior to your business as a business owner. Okay, so can you make this is the final question. Can you make decisions with available information at hand right now? Okay, can you make decisions? Do you feel comfortable with the information that you have at hand to make decisions? If the answer is yes, perfect. You know, hopefully you learned some new concepts here about ratios. But if you're not, you know, IRS, the tax preparers, creditors, they need this information to make decisions. Don't you feel the same? So try to schedule a time to go over your financials. If it's not in the calendar, it's very unlikely that it will happen. I don't know. That's something about me. I always tell, my wife and the children, just send me an invite and we get organized and things will happen. And the quality of the financials will depend on your process. Garbage in, garbage out. Okay, that's a golden rule. So recording the transactions, organizing the transactions, it will lead you to adequate reporting and decision making. Okay, so thank you for your participation.